We're going to talk today about this blockbuster free trade deal that the Canadian government is trying to negotiate with the European Union. It's called CETA, Comprehensive Economic and Trade Agreement. Sounds very impressive, but it will mean big trouble for Canadian workers, for Canadian industries. And we're going to run through some of the economic costs of that agreement if in fact it went ahead. Now this is what happens every time the government tries to sell us on a new free trade agreement. First of all, they pay for an economic study which supposedly proves that the free trade agreement will benefit Canada and benefit Canadians. Then they put it out in the media and reporters cite that study. They mention the study in the bottom line results as if it were fact, as if it was a proven fact that free trade will necessarily benefit Canadians. And anyone who then opposes free trade, they paint us as if we're economically illiterate, that we're opposing it out of ignorance or out of some kind of narrow vested interest. But in fact, we aren't economically illiterate. We are economically literate because we live in the real world where we have to worry about keeping our job and whether our industries have a future or not. The problem is very few people, not the reporters, not the politicians, actually dig in to examine how that economic model that came up with those results was built, what the assumptions were, how it actually works. And nobody ever goes back to check after the fact whether the model's predictions were actually true. They could do that because we've been debating free trade in Canada, as you know, for a quarter century. For a quarter century, they've been giving us these economic predictions from their models and pretending that they are fact. So we can go back and check the evidence, and in fact, we'll do that in this report, but the evidence is not there to suggest that free trade always benefits us. In fact, it hurts us. This debate now over the Comprehensive Economic and Trade Agreement, the CETA, with the Europeans is like deja vu all over again. Okay? The same thing is happening. In 2008, late 2008, the Canadian government and the EU jointly issued an economic report which said Canada would get $12 billion gain in our GDP from free trade with Europe. Then reporters begin citing this as if it's fact. It also was a CGE model, computable general equilibrium model, just like the ones that came before it. But nobody ever goes through to actually check how the model was built and how it worked, what the methodology was, whether it was realistic or not, or was the number just picked out of thin air. And nobody checks to see if the predictions of the model actually make sense, given what we know about the real world of trade and investment flows between Canada and Europe. So that's what we're going to look at in this study, in this talk today, is looking at the reality of our trade with Europe, how it is structured today, and what the effects, the likely effects of a free trade agreement with Europe are going to be. Now, you don't actually need a computable general equilibrium model to do this. It isn't rocket science. You could actually just look at the pattern of trade today between Europe and Canada. This graph shows, this pie chart shows current European exports to Canada, about $45 billion a year, quite a bit of exports. The red portion shows the share of Europe's exports to Canada that are value-added, high-tech manufactured goods. The black part shows what is more resource-oriented, agricultural products, less processed products. So Europe exports a lot to Canada, $45 billion a year, and most of it is high value-added, high-technology manufactured goods. Compare that to what we sell the other way, going back to Canada. This pie chart shows that we only sell about $30 billion a year in Europe, so quite a bit less than we buy from Europe. Also, half of our exports to Europe are these basic resource products, oil, coal, minerals, agricultural products, things that aren't processed, things that don't have technology or value added in them, just mostly stuff that we dig out of the ground and sell to the Europeans. So two problems become evident immediately. We sell less to Europe than we buy from Europe. Number two, the stuff we sell is very unsophisticated resource products rather than high-tech value-added manufactured goods. Okay? Here's another reality of the trade today. Look at the tariffs on trade in the two directions to imagine what is going to happen when we take those tariffs away. That's what a free trade agreement does, in part, eliminates those tariffs. The Europeans have an average tariff on our exports to them of 2.2%. But Canada has a higher tariff on imports from Europe. More than half again as high, about 3.5% is our average tariff. So put those two things together. They're selling 50% more to us than we're selling to them, and the tariffs that they will see eliminated in Canada are more than 50% higher than the tariffs that would be eliminated in Europe. So even without a computable general equilibrium model, we can immediately see that a free trade agreement between Canada and Europe will give a much bigger boost to Europe's exports to Canada than it will to Canada's exports to Europe, because they have much more going here in the first place, and the tariff reduction under free trade agreement will be larger for them. The inevitable result is our existing trade deficit with Europe, which is in excess of $15 billion a year, will get worse. That's what you can see just by looking at the existing real-world data, the existing trade relationships which we have, and incredibly, the joint study which the Canadian government and the EU released confirms that. They do acknowledge that the existing trade deficit will get much wider under a free trade agreement. So the joint report does acknowledge that our trade deficit with Europe will widen. They estimate by about 8.5 billion euros. The report from the government actually uses euros as their currency. Yet they still claim that Canada will enjoy big gains in gross domestic product and national income of almost the same amount, 8.5 billion euros, or about $12 billion Canadian. So how is it that our trade performance can deteriorate, which they acknowledge, yet our economy will grow? That is rocket science, or perhaps alchemy. It's like turning water into wine, if you like. How can you take a negative trade result and have a positive gain for our GDP as a result? One interesting point to keep in mind, this study that was released, it was released jointly by the European government and the Canadian government. It was 100% made in Europe. It was European economists who have consulted for the EU before, who took one of their existing models and rejigged it to examine the impacts of a Canada-EU deal. So there was no real Canadian input to this, and I don't know if anyone else finds that a little bit suspicious. I think of two boys in a schoolyard. You know, one's a European, one's a Canadian boy. The European boy comes to the Canadian boy and says, okay, you give me 16 billion euros, and I'll give you 8 billion euros. Okay? And the Canadian boy would naturally say, why? That doesn't sound fair. Okay? But then the European guy points to his enforcer, you know, a big burly economist behind him, who comes out with a big study and says, this will be good for you. It doesn't look like it'll be good for you, but it will be good for you. Shouldn't we be doing our own analysis as Canadians of an agreement like this in terms of how it's going to affect Canada, instead of using a second-hand European report and then actually believing that this is going to be beneficial for Canada? We are actually negotiating with the Europeans here. We're supposed to be in a bit of an arm wrestle, yet our government is using the European study to inform them. How do they do that? How did they milk a silk purse out of a sow's ear, if you like? How did they take a trade deficit and convert it into an economic gain? First of all, is the standard tricks that they have played on every CGE model, computable general equilibrium model, that they have used in all of the free trade debates. Those models are all based on a set of incredibly unrealistic assumptions, and I'll quickly run through them. They assume full employment, so they assume that no one is unemployed. So don't worry that you'll lose your job because of free trade. You can't. The model assumes you'll be fully employed. They also assume a supply-constrained economy. What that means is the Canadian economy, both before free trade and after free trade, will produce as much as it possibly can. There'll be no impact on how much we produce. The only impact of trade is therefore on exactly what we produce. And this obviously is not remotely true. We see unemployment and unutilized capacity in factories that are closing around us every day. They also assume uniform factor pricing. That means every worker in Canada gets exactly the same wage. So you don't have to worry that a high-wage industry, like, say, the auto industry, is going to lose jobs and that you'll end up working at Tim Hortons instead. It doesn't matter, because the auto worker and the Tim Hortons worker make the same wage. Sounds realistic? Not exactly. They assume a single representative household. So the model assumes that the whole country is composed of one household that shares all the income that comes in. So there's no question of there being winners and losers. We're all one big happy family as a country. If you believe that, walk down to Rosedale or some other rich neighborhood in Canada and ask to share the money that's being enjoyed there. You'll get arrested. Okay? The model assumes no international capital mobility. So a company cannot take a plant and move it from one country to another because the workers are cheaper. The model just assumes it can't be done. The model also assumes that trade will be balanced between Canada and Europe and all the other trading partners, so you can't have a trade deficit. None of those assumptions are true. In fact, they don't remind me of Canada, a capitalist country. It sounds like a utopia to me. Full employment, producing as much as you can, sharing everything, and keeping all your capital at home. I vote for that system, okay? But that isn't the system we live under, right? We live under something very different. So those are the standard assumptions that show up in every computable general equilibrium model. Now, it's interesting to note, of the $12 billion gain that the study forecast, only about 20% of that gain actually came from that set of ridiculous assumptions applied to the process of tariff reduction on both sides. That explains about 20%. Even those far-fetched assumptions can only explain about $2.5 billion out of the $12 billion. Okay? How did they get to $12 billion gain? Well, they had to go even further with their assumptions. Okay? There's an extra set of what I call super-duper assumptions built into this particular model. Not a standard CGE model, but this particular model of the European case. And these are these super-duper assumptions. First of all, they assume that because of the elimination of non-tariff barriers, which they can't measure and they don't try to estimate, they just snap their fingers, as the economists who wrote the paper, and said the costs, the delivery costs of all manufactured goods traded both ways will fall by an additional 2% because of the elimination of non-tariff barriers that we can't see and we can't measure. They just assume that that happens. That almost doubles the impact for us, because remember, the European tariff was only 2.2% anyway. So just by snapping your fingers, you get extra benefits there. In services industries, which are not as intensively traded between countries, they make an additional assumption. They assume that it becomes as easy to trade services like transportation, telecommunications, banking, business services, as easy to trade them between Canada and Europe as it is to trade them within Europe. So it'll be as easy as for a Canadian bank to set up in, say, the Netherlands and sell services there as it is for a German bank to set up in the Netherlands. In essence, they have assumed away the Atlantic Ocean, right? Never mind the distance, right, and that little thing called an ocean between us, let alone language and culture and history and structures that have to get built up to trade services. They just assume it will become in essence, that Canada will become part of Europe. Those two assumptions, bizarre as they are, account for another 30% of the gains, the $12 billion gains that were forecast. So we're in a ridiculous no-no land here, right? And we've still only accounted for 6 of the $12 billion gain. They had to make an additional third assumption in order to come up with a $12 billion estimate. And that is the assumption that any additional income that is earned in Canada, a portion of it will be saved. People will put it into their bank accounts, and then it will be invested in businesses in Canada. It can't be invested in businesses anywhere else. It can only be invested in Canada. And this is how they actually get another 50% of the benefits. So of the $12 billion, half of them come from this assumption that anyone who makes more money will save some of that money, and then through the stock market it will be productively invested in a Canadian business, which is nonsense, right? That isn't remotely what's happened. In fact, far from saving, the more consumers have earned in recent years, the more they've gone into debt. That's why Canadians owe 150% of their disposable income in debt. There isn't savings like that going on, and there certainly isn't investment in Canada. I would love to see it. Again, I'd vote for a measure which says all savings of Canadians have to be invested in Canada. I would love that. But that's not what, of course, a free trade agreement does. So these assumptions are bizarre, but necessary, because otherwise you wouldn't have the proof that free trade agreements will benefit. And in fact, this is not proof. A computer model like this is in essence a numerical toy that the economists love to play around with and simulate different scenarios and see what numbers they get, but it doesn't prove anything. Let's take a different approach. Let's abandon those ridiculous CGE assumptions. Let's describe current trade and employment patterns between Canada and Europe in detail. We'll apply escalation factors to that trade based on the elimination of tariffs and on historical evidence about how trade flows are likely to respond. And then we'll calculate the resulting impacts on bilateral trade flows, on jobs, and on GDP. Okay, we won't assume full employment. Okay, we won't assume a socialist utopia where all capital has to be invested in Canada, much as I would like one. We'll instead look at the real world. The initial data that we took for this alternative model included data on 23 different sectors of our economy, all the goods-producing sectors that trade between Canada and Europe. We looked at the actual 2009 trade data. The Canada-EU model did not do that. We look at sector-specific tariffs and consumer purchasing patterns and elasticities that are published. We also look at actual jobs in each sector that are available from Statistics Canada. Finally, here's a unique twist. we also looked at the history of Canada's other free trade agreements to see what could we learn from that history about what's likely to happen to exports and imports and jobs under a Canada-EU free trade agreement. So what did we get? First of all, in terms of learning from experience, there's some important information that we have to look at. Canada has already 5 free trade agreements that have been in place for several years. Those are with the United States and Mexico in the NAFTA, a free trade agreement with Israel, with Chile, and with Costa Rica. We've also signed a couple of smaller ones more recently with Panama and Peru and so on, but those ones have not had enough time to have a real impact yet. So we've looked at the 5 that have had an impact. What happened to our exports under those 5 free trade agreements? It turns out that our exports to the free trade partners grew by just under 5% per year after a free trade agreement. However, our exports to other countries that we didn't sign free trade agreements grew by more than 5% a year. So if our goal is to increase exports, and I actually think that is a good goal for Canada, signing a free trade agreement is not the way to do it. Our experience with free trade agreements is actually negative. Same is true on the import side, okay? After a free trade agreement was signed, our imports from free trade partners grew at about 9% a year. Our imports from other countries that we hadn't signed free trade with grew only at about 7%. So in every case, our trade balance performed worse with the free trade partners than it did with countries we didn't have a free trade agreement with. If we want to promote exports and promote a stronger trade balance, signing a free trade agreement is exactly the wrong way to do it. And we'll take advantage of that historical information in designing our model, which looks at 3 scenarios. We considered 3 cases that we look at with our number crunching. First is when the 2 sides simply eliminate their tariffs, okay? And then we apply an escalation factor based on consumer elasticities. The second approach is where we directly apply the experience of our 5 previous free trade agreements to the European case and say, what if the European case exactly mirrors what happened with our other free trade agreements? The third case is where we now consider the impact of the rising Canadian dollar on our trade flows, the fact that the dollar has gone up by about 19% against the euro since the 2 sides started negotiating. What is that going to mean for our trade flows with Europe, as well as the impact of tariff elimination? Those are the 3 scenarios that we considered on the basis of real-world data, not CGE models. And this table that you'll see considers the impacts of those 3 scenarios, looking at the impact on our trade balance, on employment, and on Canadian GDP. The simplest one was just the elimination of tariffs on both sides. That leads to a deterioration in our trade balance of $8.5 billion. That, remember, is consistent with what the government's own study projected. The loss of 28,000 jobs. Why do we lose jobs? Well, we do have some increase in exports to Europe. That creates jobs. But we have a larger increase in imports from Europe. That destroys a larger number of jobs, and the net impact is minus 28,000. And that translates into a loss of about 0.5 percentage point of Canadian GDP. If we look at the experience of our 5 other free trade agreements and extrapolate that to the European case, the numbers are a bit worse. We're looking at about a $14 billion increase in our trade deficit, the loss of 46,000 jobs, and the loss of close to a full percentage point of Canadian GDP. The worst case scenario, though, is when we consider the impact of that 19% rise in our dollar, because now even our exports to Europe might fall, even though we sign a free trade agreement, because the 19% damage done by the higher dollar more than offsets the 2% opening that we get as a result of the free trade agreement, if you follow me. Under that scenario, we look at a $45 billion increase in our bilateral trade deficit with Europe. Devastating. 150,000 lost jobs in Canada and a 3% reduction, experienced over several years, not overnight, but after the adjustment is completed, a significant reduction in our GDP. These numbers are negative. I don't know which scenario is going to pan out. I do know there's almost no real-world circumstance under which you can reasonably predict that free trade with Europe will actually lead to increased jobs and improved trade balance for Canada without imposing those ridiculous assumptions of a CGE model. We have to abandon that old idea that just having free trade and free markets and free business will make sure that our economy operates at its potential and ensures our prosperity. That kind of trickle-down logic, right? It hasn't worked for Canada. What did work was when we had proactive strategies, what I call integrated industrial and trade strategies, by our governments, working in partnership with companies and with unions and with universities to develop key high-tech innovative industries and make sure that Canada has a share of them. The Auto Pact is an example. That's how come we have an auto industry here. The aerospace industry also has benefited from proactive strategies like that. Telecom, other high-value industries that we have always benefited from governments getting involved and developing those sectors and making sure that Canada gets our share. We can learn from other countries in the world as well. Finland doesn't export raw trees like we do, even though they've got a lot of trees. They export expensive finished wood products. They also export a lot of high-tech telecommunications equipment. Korea doesn't just trust free trade. They act proactively to protect their home market, okay, make sure that their industrial companies, whether it's Hyundai or Samsung, are strong, and then use that home market as a platform to go out into the world with successful exports. Germany doesn't trust free trade. Germany has a whole set of proactive policies where you have government, training institutions, companies, and unions working together to develop high technology exports, and Germany is the most successful exporter in the world. Those are the sorts of policies that we should be imitating. A free trade agreement won't do it. We do need trade. I'm all in favor of more trade and building Canada's exports, but free trade is not really about trade. Free trade is about a set of rules that benefits companies but won't actually benefit our economy. The full study that has all the details of the talk that we've just completed is called Out of Equilibrium. You can download the full study at the site of the Canadian Centre for Policy Alternatives, which is policyalternatives.ca. And I thank you very much for your attention. Now let's go out and stop that free trade deal. Thank you.